When we talk about investing, the goal is often to grow your money without taking on unnecessary risk. That's where something called an exchange-traded fund, or ETF, comes in. Think of it like a basket holding tiny pieces of many different companies. Instead of betting all your money on one single stock, you're spreading it out. The VEA ETF, officially the Vanguard FTSE Developed Markets ETF, is one of these baskets. Its job is to give you ownership in thousands of companies located in the world's most stable, developed countries, excluding the United States. It's a simple way to invest internationally, tapping into growth outside the US. Why invest outside the United States? The main reason is diversification. By holding VEA, you tap into economies like Japan, the UK, Canada, France, and Switzerland. These countries help smooth your returns if the US has a slow year. One of VEA's biggest selling points is its incredibly low cost. The expense ratio for VEA is just 0.05%. On a $10,000 holding, that's roughly $5 a year in fees. So instead of one risky bet, you own thousands of established companies, a safer way to build wealth. VEA is a foundational building block for a global, diversified, low-cost portfolio. Now, let's talk about one of the best parts of owning investments, getting paid just for holding them. These payments are called dividends, a portion of company profits shared with shareholders. Because VEA holds thousands of stocks, it collects many small dividends, then passes them along to you as the investor. VEA pays dividends quarterly. You can expect deposits about 4 times per year. Dividend yield is the annual dividend divided by the ETF price. For VEA, it's often attractive compared to many US funds. As of late 2024, VEA's yield has been hovering around 3%. So a $10,000 holding at 3% yields roughly $300 per year in dividend payments. You can take the cash or reinvest automatically to buy more shares. Reinvesting dividends accelerates compound growth. Dividends earn their own dividends over time. Dividend amounts can fluctuate year to year based on company profits and policies. In 2023, VEA paid about $1.41 per share in total dividends. In 2022, it was around $1.55 per share. Year-to-year variability is normal. The key is consistency. VEA is built from large, dividend-paying, stable companies. That steady income plus long-term growth makes VEA a compelling addition for income-minded investors. When you invest, you want to know how an asset has performed. Past performance isn't a guarantee, but it informs expectations. VEA's performance has been steady, appropriate for a fund of large, established international companies. Over the last 10 years, as of early 2025, VEA delivered roughly 4 to 5% average annual return. To illustrate, imagine investing $10,000 at the start of 2015 and reinvesting dividends along the way. That $10,000 could be approximately $16,000, $17,000 by mid-2025, demonstrating the power of long-term investing. You didn't need to trade actively or pick winners. A single buy-and-hold strategy did the heavy lifting. Reinvesting dividends compounds returns over time, which materially boosts your ending balance. Compare VEA to the US S&P 500. The US had an exceptionally strong decade, often outperforming international markets. That outperformance has caused some to question the need for international exposure. But market leadership is cyclical. Different regions lead at different times. Historically, there are multi-year periods when international stocks outperform the US. Holding both US and international funds helps you capture growth wherever it happens. That smoothing reduces portfolio volatility and single-country dependency. Recent years have been a mixed bag with challenges like inflation and shifting rate policies. VEA's role is not to chase explosive growth, it's a stabilizing bedrock of diversification. When you buy a share of VEA, you own a small piece of over 4,000 companies. That's massive diversification in a single purchase. Top holdings include blue-chip multinationals like Nestlé, Samsung Electronics, Toyota, and Roche. These are established, profitable companies with global operations. The fund is weighted towards certain developed countries and balanced across sectors. Here are the typical top 5 country allocations. Japan makes up the largest portion, roughly 20%. The United Kingdom is another major allocation. Canada is a top country weight as well. France and Switzerland round out major allocations, giving exposure across stable political systems. By sector, VEA is well-balanced: financials, industrials, consumer discretionary, healthcare, technology, and consumer staples. Financials make up a meaningful slice, as do industrials and consumer sectors. Technology and healthcare are present but not dominant, keeping the fund diversified. VEA tracks the FTSE developed all-cap ex-US index. Vanguard buys by market cap, keeping it passive and low cost. So let's bring it all together. Why should a regular investor seriously consider VEA? First, pure diversification. Many US investors have a strong home country bias. Concentrating all your investments in one country is a risk. VEA expands your reach globally. VEA is an easy, one-ticket solution to get that international exposure. Pair it with an S&P 500 or total US market fund, and you instantly have global diversification. Second, the 0.05% expense ratio keeps more of your returns working for you over decades. Over 30-40 years, low fees can translate to tens or hundreds of thousands of dollars in compounded gains. Third, steady dividend income around 3% provides reliable cash flow or reinvestment capital. VEA also gives exposure to foreign currencies, which can act as a hedge if the dollar weakens. When foreign currencies strengthen versus the dollar, your international holdings can gain additional value. VEA represents a disciplined, evidence-based approach, not chasing hot stocks or market timing. Instead, you own a broad slice of successful companies across the developed world. For a new investor, pairing a US fund with VEA creates a low-cost, globally diversified portfolio. It might not be flashy, but when securing your financial future, boring is often beautiful. VEA is a smart, simple, and effective choice for international exposure, a cornerstone for many long-term portfolios.